Hello and welcome to another edition of Market Update Monday, one that's coming out a couple days late. I've been down sick with the flu after the Thanksgiving holiday. Sounds like half of Clark County is down with it as well. So apologies for the tardiness, but it actually worked out well because we have a bunch of new data that's come out this week. Quite a bit of things to talk about. And I want to take a little bit of extra time today to really dive into what we're seeing and what I think is going to happen in the future. We're most likely at a tipping point here with inflation. And so we're excited about that. We've been talking about it for a while. We've gone through the point in time where we had mixed indicators, which is often an indicator of being at an inflection point. Now we're starting to see more and more of those indicators pointing in the direction that we want. So today's December 1st. It's been almost a year that we've been talking about this. It's crazy to think that that much time's gone by, but congratulations to those of you who are still in the business. And I think we're more than halfway through this. So let's jump in right now. Today we got the Personal Consumption Expenditure Index report, PCE for short. Why I want to talk about this is the Fed's preferred metric. And the reason it's the Fed preferred metric is that it has the best indicator of what consumers are doing, what the population of our country is spending money on. And so that's what the Fed is directly trying to affect with their monetary policy. All right, so PCE came in this morning at an annualized rate of 5.0%, which was less than expected. We're seeing a trend here. The numbers keep coming in a little bit better than expected, which means we're building some momentum. We were down from 5.2 last month, so it's a 0.2% improvement. The month-over-month number was 0.2%. I know I'm throwing a lot of numbers at you, but just like with the CPI, we're looking at the year-over-year number. But more important to me is the month-over-month number because we can start to dive into the trend. At a 0.2% month-over-month increase, if we annualize that, we would be around 2.4%, maybe a little higher once you compound it. But that gets a lot closer to the Fed target, okay? So 5.0 is still high, but remember, that's taking into account last month and the month before and the 10 months before that. Okay, so we're heading in the right direction with that. The total PCE figure, which includes things that are outside of the control of monetary policy, was at 6.0%, which was down 0.3. So both sides of that coin are improving right now, and both were better than expected. And I think this is important because while this is the Fed's preferred metric, it's also one of the last ones that pivoted in the direction that we wanted to see. Last time we spoke, we had mixed signals. We had some pointing in the right direction, some pointing in the wrong direction, some were sort of neutral. And what we're seeing now is more and more of the indicators that we look at are turning in the direction we want. So that's a solid sign of what's coming. Yesterday, the employment numbers came out. I'm not going to dive into all the details there, but what we saw was wage growth cooling off. We saw new hires cooling off, and we saw unemployment starting to move in the direction we want. When you add that to the fact that corporate America is publicizing their intention to start reducing staff levels, they're going to pause hiring, they're starting to pull back. We're starting to see the labor market contracting, which is really what the Fed wants to see, okay? So from our standpoint, consumer products are coming down. We've got a number of sectors where prices are cooling off, car prices and consumer goods and staple products, and all those things are getting back under control, or heading in the right direction, I should say. Then you add to it that the labor market's starting to soften. We still have a long ways to go, but it all starts somewhere. And I think we're at the point where the Fed is starting to see progress, and that's why he was in a better mood yesterday. More on that later. One other thing to note with respect to the current market, in the October numbers that we saw for CPI, we actually had some increases in fuel costs in there that have since trended the other direction. In November, gas prices came down quite a bit. So when we get the CPI numbers next month, we expect to see more improvements. So let's talk about the big thing that happened yesterday. The market rallied 700 points. Mortgage rates all of a sudden improved. And I started getting texts and calls from all kinds of people. What's going on? What's going on? Why are things improving? Well, for the first time in a long time, Jerome Powell, when he spoke, he was less hawkish. When you hear people say hawkish, what they're talking about is him being negative and trying to calm us down and scare us into, stopping economic activity. Spend less money. Things are going to be difficult for a long time. We're going to raise rates. And he really starts to strike a tone of fear. Yesterday's meeting was different. He is seeing signs of progress, but he's still cautious. He's still saying we have a long ways to go, but he indicated that it may be time, which means it is time, to slow the pace of rate hikes.
Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down.
We've all expected this for some time, for the Fed to slow down and be done with the 75 basis point hikes and to move more into smaller hikes. And so the expectation now from the market as a whole is a 50 basis point hike in December, smaller hikes after that, and maybe the end of the hikes coming in the first quarter. Why it was such a important speech yesterday and had such a market reaction is it's the first time that he basically confirmed that's what's going to happen. Okay, so that's a great sign. It's an indication from the man who has the most power in this situation that we're at the point we were hoping to be at this point in time. So the market rallied. Powell's still being cautious and reserved because he doesn't want us to think it's over and we can just go back to spending money and everything's going to be great. We still have a ways to go, but we're heading in the right direction. And I actually think inflation is going to improve a little faster than they do. We'll see. The reason why I think it's going to improve a little bit faster is I have a differing opinion on the shelter costs component of inflation than the Fed does. When you look at this chart that I've got, we've got two different metrics here. The blue line is CPI rent. This is the figure that the Fed uses when they're talking about the shelter component of the total inflation picture. And if you recall, the shelter component makes up about a third of our total inflation picture. So we could have all the components in the other 2/3 improving, but if rent and rent equivalent keep getting worse, it sort of serves to buoy the total inflation in the CPI picture. The yellow line that says ZORI is Zillow Observed Rent Index. And what that is Zillow actually keeps track of rental rates and what leases are signed for and et cetera. But they're doing it on a monthly basis. There's not this lag that we see with the CPI. When they're factoring the CPI number, they're actually doing a survey and asking people what they pay for rent. Well, most people sign 12-month leases. So if you call somebody and ask them what they're paying in rent, they may have signed that lease a month ago, 6 months ago, 11 months ago. The data that we get there is pretty old. It's really kind of a lagging indicator. And it's evidenced by this. If you look at this chart, you can see that during the COVID, rent prices, or the appreciation of rent, I should say, dropped dramatically. And that's because in a lot of parts of the country, we weren't allowed to raise rents. And so we had the rents drop and then they exploded back up. But the CPI number took a while to reflect that. And the reason it took a while to reflect that is it only reflects it when people sign new leases. Whereas the ZORI was much faster in the upside, but is also now starting to decelerate. We're going to see this month, I believe, an updated version of this chart where the ZORI number actually intersects with the CPI number, except that CPI is still heading up and ZORI is heading down. What does that mean? Well, it means that the data that's being calculated into the total inflation picture, in my opinion, has some old information in it. And what we're actually seeing is a rapid deceleration of the increase in rents, which is what we need. And so I think we're actually going to see the inflation picture improve faster than what they're saying for this reason alone. Okay, so keep that in mind. I don't want to make a bold prediction, and obviously the Fed chair is in that position for a reason. He's one of the leading experts, but I think they're using the wrong data here. So one of the things I was encouraged to see during Fed Powell's speech is he actually did sort of reference the shelter costs. And without explicitly saying it, it sounds like they're actually looking at this data now. So that's a good thing. And I hope that they start to take that into consideration, because while it might take a while for the total CPI number to take into account the improvement in rents, the Fed needs to take it into account when it comes to their policy. Okay, so looking at another chart here from Zumper, the national rent growth on a year-over-year basis, based on the metrics that they use, is actually also declining. So we're seeing from a number of different sources that the rental picture is starting to improve. I've also got a graph here showing the gas prices over the last 18 months. You can see that it peaked in June. We had a little bit of a bump up in October, which I mentioned earlier, and now it's heading back in the right direction, which is welcome news. All right, so back to the Fed comments. So the Fed was referencing a number of things in this meeting that he hadn't previously, which were things that we're all anxious for them to take into consideration. Where it seemed like before they were only focused on the total inflation picture without taking into account some of the things that are actually improving. So the reason why the market's reacting as positively as it is we all believe now that the Fed is moving in the right direction, and they may actually have a reasonable chance at a soft landing. So what is a soft landing? A soft landing is, can we get out of this inflation mess without putting ourselves into a deep recession? And there's a lot of concern about this from a lot of people, and myself included. Is it possible? It's going to be really tough and really tricky, but it appears that the odds of success are actually improving. And that's got people excited. We don't want to get ahead of ourselves with this, but if the Fed is able to put us into a mild recession while getting inflation under control, that's great news for everybody. Okay. In our business, in the real estate world and the mortgage world, getting into a mild recession would actually be beneficial. We don't want to cheer for that, obviously. We're not hoping people get laid off, but at the end of the day, we need the market, the economy to cool off so that we can get back to normal. One other thing to note, we have seen in the past month, interest rates have been coming down relatively consistently. The 10-year Treasury, by the way, I want to touch on this. Everybody thinks that when the Fed raises rates, that mortgage rates go up, and that just simply is not true. Okay, the Fed is going to raise rates in December by 50 basis points. Mortgage rates are actually coming down right now. Why is that? Well, mortgage rates are based on the 10-year Treasury, okay, not on the Fed funds rate. The 10-year Treasury acts more like the stock market does in the sense that it's based on expectations. It's a forward-looking metric. The stock market, for example, rallied yesterday because of the Fed's indication that they were going to slow down on interest rates. And that bodes well for large companies. They can borrow money, hopefully, without it getting too much more expensive. So the stock market rallies because of good news of what could happen in the future. The 10-year Treasury is very similar. If we think that mortgage rates are going to need to continue to rise in order to battle inflation, then the 10-year Treasury goes up, which causes mortgage rates to go up. When we think that inflation is starting to get under control, there's a sort of a sigh of relief. The 10-year Treasury settles a bit and mortgage rates come down. The 10-year Treasury eclipsed 4% a few weeks ago, and now we're back down. We touched 3.6 earlier. And so that was a meaningful reduction, which has translated into mortgage rates dropping. So the question is, what happens next year? Well, there's a lot of variables. There's a lot of road to cover still. There's a lot of improvement that still needs to be made in the inflation picture. And there's things that could happen that interrupt all of these things. But if we continue to head in the right direction, mortgage rates should stay calm. And I think we may be through the worst of the hikes. There are some people in our industry that are predicting that rates are going to be down in the 5s, and some are even saying in the 4s next year. I don't know that that's going to be the case, but I do think we're going to continue to see what we're seeing now, which is a softening of mortgage rates. And the reason I think that is because it overreacted, like everything does. We went up to 7.25 way too quickly, and now it's easing back down. And if we continue on the path that we're on, we should continue to see it settling a bit. Okay. So now the good news that nobody's talking about, what I think is actually the best news of all of this data. We are probably heading into a recession. Okay. Nobody wants that. But unlike previous recessions, unlike I think every recession in my lifetime that I can remember, this one's on purpose. Why is that good? Well, it's good because we are forcing ourselves into a recession with our monetary policy. Okay. But the good news is once we've achieved our goals, once the Federal Reserve has achieved their goals, they can flip the switch and change it just like that. When you go into a recession on purpose, as long as you don't cause a financial crisis in the process, they should be able to flip the switch and turn it back on as soon as they want to. So I'm optimistic that that's going to happen. I'm at the same time concerned that they overreact, but we just got to keep an eye on it and keep looking at the data, stay on top of the stuff, and know where we're at. I hope you all found this helpful. Thank you for watching, and make sure you like, subscribe, and share this with a friend. Have a great day, and KFA.